Hello, everyone, and welcome to another edition of the Dividend Power Hour. If this is your first time, welcome. My name is Mark Rusin. I'm a CPA, and we do these each and every week. So let's get started by let me know. I see a bunch of folks already in the comment section, but let me know, where are you tuning in from? I'm here in Southern California. Again, my name is Mark Rusin. We do these Dividend Power Hours each and every week, just going through the state of the economy, the state of the stock market, and just by making this completely interactive, taking your questions and hearing different points of views from like-minded investors. So thanks again for tuning in. We have a great show loaded up for you today. So let me know, where are you guys tuning in from? I already see a bunch of familiar faces in there, and hopefully we have some new faces as well. This is always a fun time to get together just for an hour talking stocks. So let's see where you guys are all tuning in from. I see Tommy's in there. My buddy Jim is always in the house. Love it, from Nebraska. He sold WPC. I did too, Jim. I just, there's just too many other spots to be able to put money to work right now. Wasn't really happy with the decision where they went. So he bought some RITM, some STAG, some Main, and O, and Fund initiated a position in TGIF. Awesome. So let me know where you're tuning in from, and let me know if you bought any stocks this week. We've had a pullback of sorts in the stock market over the past 5 days or so, or really the past 2 weeks. So you may have be starting to get some opportunities that you've been waiting for. What else we got? We have Matthews in the house, familiar face there. Tommy picked up some SCHD, some ADC, and some Vici. So he went REIT hunting there. Jim commenting, loads of insider buys in Agree Realty this week. That's a great sign. I did not see that. So that's a great set. That's why I love doing these Dividend Power Hours, because I'm not just here to teach you. I try and take something away from these every time as well, because you're just hearing other insights from other folks. That's what makes this community so awesome. Dan is in the house. Dan got some SCHD and some O. We had O drop under $50 this week. When was the last time you saw O under $50? Investors Edge tuning in from New Orleans. I will be in New Orleans actually in, what is that, mid-October-ish. We have a financial content creators conference out there. So never been. So if you have any, I'll be in downtown area. So if there's some recommendations, you let me know. Razik from New York is in the house. Good to have you. Las Vegas with James. Checking in from Minneapolis with Drew. Hello, Mike from North Billerica. I probably butchered that. Peter Hahn is in the house from SoCal. Love it. Drew is Minneapolis. I like it. Temecula, Kristen, good to see you again. Costa Mesa. Okay, now we're getting closer to me. That's in Orange County. Tuning in from Singapore. There we go. Love it. First time attending the live sessions at 7 a.m. there. Awesome. Good to have you. So Mike bought some SCHD and some O. Chicago's in the house with Kenny. Missouri is in the house with Wes. Fabio, good to see you. What do we got here? SCHD, some Philip Morris. So we get some high yield and Vici. Went through with a student today that's going through my 6-week investing accelerator course. And right now I have them pick, what is a stock that you want to look into as we go through financial statements, understand valuations and how to value a stock. Vici was what he picked. So we went through the Vici financial statements today. New York City again. All right, Jim, let's see it. Agree Realty Insiders bought 1.7 million worth of shares. According to recent SEC filing, executed a purchase of 30,000 shares. Imagine buying 1.7 of just one stock. That's when we know we are doing well. Rochester is in the house there. Ethan, Waimea, Big Island. Awesome. I love Hawaii. Got rid of VXUS, trimmed down, and bought some SCHF. Awesome. You guys are already just in the mood to interact, and I love it. So I'm going to pull up the slides that we're used to seeing each and every week and just go through the status of the stock market, and the economy. So again, if this is your first time joining, this is the Dividend Power Hour. We like to make this interactive and fun. We talk stocks, we talk economy, and we talk about making money. So here is our economic outlook, our market update. So the Dow Jones is still holding on to a little bit of a gain, 1.5%. Over the past 5 trading days, we are down 1.2%. So that index is the major loser so far in the past week or so. And really, I guess the past year, since they're only up 1.5%. The S&P 500 up 12%, down about 0.75% over the past 5 days. And the NASDAQ, the clear winner, in 2023, which will probably end that way, is up 26.1% on the year and down just 0.2, about a 0.25% over the past 5 days. So valuation made a little bit of change here. So now that we're entering Q4, we've been showing the 2024 EPS. I actually put in the 2020, we've shown the 23 EPS. Now I'm showing the 2024 EPS numbers. So we want to look a little bit further out. There is risk with that because you never know where things are going to kind of come in. But I like to, as we get closer, I like to look 12 months out to see where things are going. What are valuations looking like? So with 2024 EPS at 247, remember, it's a big uptick. We think a lot of economists, analysts believe that Q4 of this year is going to be quite strong, and that's going to continue momentum into 2024, which a lot of them are hoping and expecting big earnings numbers there. So if we use 247, we take the current S&P 500 divided by that 247, that gives us a forward price to earnings multiple of 17.4 times. If we look at over the past 10 years, the average forward price to earnings multiple, 17.4 times. So we're exactly right there at fair market value if these metrics obviously come in. So let's scoot over to our slides here. And as we do, we like to look at this Yardeni research. They send this out every single week. It's completely free. You can find the S&P 500 estimates. They'll also show actuals for the past years as well. So if we go down here to 2023, you can see we've been hovering around an estimate of 2020. So when you come to this show, we always show that 221 estimate for the full year. Here's where I'm getting the 247 number from. So you can see that for the entire year, 247 is expected. We've seen, slowing growth in terms of earnings through the first 3 quarters, expected in Q3 as well, but then a jump in Q4 that we're just starting to enter here in the next few days. 9.2% earnings growth year over year. And then you can see that momentum carrying over into Q1, another 9% almost. Q2 and Q3, Q4, all of those 12, 13% EPS growth there. So those are big estimates there. So even if they are big though, and I look here and I say, okay, that's at 17.4 times, that's a lot of big expectations there. I'm still not at the point where, the S&P 500 is completely undervalued. Let's pour a bunch of money into it. It has gotten a lot better, as we know, here in September, just due to the pullback that we've seen so far. So let's take a look now and just keep moving through our slide deck here. So let's go back to the slide deck. So now moving on from valuation, we're at 17.4, right in line with our 10-year average. Now let's take a closer look at interest rates. So we look at interest rates each week, as this is really weighed on the stock market, just because when you have interest rates this high, there's other options for people to put their money. So if you have interest rates right now that are at, sub 5% or so, that's pretty much risk-free. And you have a lot of corporate bonds that are out there, even high yield savings account. I have a high yield savings account at 5.4%. That's completely, risk-free. So for the most part, so there's just not a whole lot, you don't need to put all of your money into the stock market right now. There's so many options. And that's what you'll see. I have a slide on here that could be a potential catalyst moving forward for investors. So the 10-year average right now is at 4.6% per se. Last week it was at 4.44. The 2-year is at 5.06, which is actually slightly down from last week, which was at 5.09. So not really too much movement there in the 2-year. Heading over to unemployment, jobless claims increased this past week by just 2,000, but still came in under expectations yet again. So about 204,000 folks that got unemployed looking for jobless claims. They're looking for those benefits. Expectations were 215. So that's a pretty wide gap there. Continuing jobless claims at 1.67. That's just a tick higher than we've seen in the past. It's up only 12,000 from the prior week. But both metrics did rise from the previous week, but still well below and still showing, no signs of unemployment ticking higher. Folks, if they do get laid off, the data is showing that they're pretty much finding a job rather quickly. However, as we've seen in the JOLTS report, which is the job openings that are out there, that's the JOLTS report that comes out on a regular basis. That is showing, that is starting to get slimmer. So there's not as many companies that are hiring. So it'll be interesting to see how these numbers kind of play out moving forward. Consumer confidence came out this week as well. Consumer confidence index was at 103. We're going to talk more about this here on the next slide, but it was down 5.2% month over month, a 4-month low. And then housing. I don't know if you've heard much about housing, but that has just been a rough area for that sector. Can't even speak today. We have pending home sales for the previous month that have plunged, and you're really starting to see those higher interest rates of 7.5, even 8% for 30-year mortgages really start to weigh not just on existing homes, but also new homes. I mean, again, I say it each and every week. If you have a 4 or 3 under 3% 30-year mortgage, why would you even want to move right now unless you had to? I think I saw a stat recently saying about 90% of all the mortgages out there right now in the U.S. are below 5% mortgage rate. So it's gonna make it difficult for the housing sector until those rates, back off a little bit. So let me head over to the comments. See, do you guys have any questions so far? Again, if you have questions, comments, just make sure you put those in that comment section below. We have a very interactive group. If I don't get to the question, someone we already had, Jim can answer questions in there. Any one of these folks that are in here on a regular basis are able to answer any of these questions as they come up. So great to have all of you for tuning in. We got about 50 folks right now as we continue to see more and more folks trickle in. So let's take a look at the consumer confidence, or what I like to call it, a lack of confidence. So the consumer confidence reading for the month of September, already up, came in at 103, and it's down 5.2%, which it was at 108.7 in the month of August. That's the largest single month drop we've seen since December of 2020. So we're talking about going back to the pandemic area there for a single month drop. So expectations for the expectations index, a completely separate index there. This aggregates short-term outlook for income, jobs, labor market, stuff like that. That was down to 73.7 in the month of September. It was at 83.8 in August, and it was at 88 in the month of July. So it's continuing momentum, and it's not just trickling lower; it's moving lower at a good pace here. So some concerns there in terms of looking out at least over the next 6 months or so. And I don't think they're wrong by any means. Historically, below 80 in that expectations index has signaled a recession over the next 12 months. Now, we've seen other, when the 2-year and 10-year crossover and stuff like that, we haven't got that recession yet. So we'll have to see what that means. Take it with a grain of salt, I guess. So, things people are concerned about: higher food prices, higher gas, especially, of late. I've had gas in the past week and a half go from $5.75 at one station here near me to, I saw it today after I picked my son up from school, $6.50 a gallon. It is just incredible here. Incredibly bad. Earnings concerns, jobs concerns. You hear a lot of these folks hearing about corporate earnings. The S&P 500 estimates that we saw aren't really concerned, but this is something that was noted in this expectation index. So definitely something to look at further. So now, we looked at the consumer confidence, then we went to the expectation index. Now let's go back and look at this chart for the consumer index, consumer confidence. So you can kind of see this dating back all the way back to 2000, and you can just see the ebbs and flows. And anytime it gets, below 100, a reading of below 100, it's likely that we've fell into a recession. The last time you could see there was right before 2007. And what did we do? 2008, 2009, we fell into a recession. Now, it took a while to climb back up, but we got out of that until we hit the pandemic. Now, the pandemic was really a pandemic-induced recession, but we climbed back out of that. Things got great again, and now we're starting to teeter on that 100 line. So definitely something also to keep an eye on. If we dip under 100, we have the expectations index under 100. We have interest rates there's just a lot of headwinds. We talk about this each and every week. There's things to be excited about, but there is a lot of headwinds. A lot of things have to go right. And that moves us to the housing sector, which is really struggling. For a while, if you look at new home builders or public home builders, they've actually been doing quite well. If we go to, I haven't looked at them in a while, but let me take a quick look at something like, what's DR Horton here? Let's see what DR Horton has been doing. What is their, where is DHI? So DHI year to date up 20%, over the past year up 50%. So there it is. Home builders are doing quite well, but this is like the first time the data we've seen here is actually new homes are starting to, not see the demand that they once saw as well. So let's take a look here at this data. Pending home sales fell 7.1% during the month of August to 71.8. 77.1%. Analysts were expecting, this is not a typo, a decline of less than 1%. That's a huge miss right there. So that was just a complete, rug pull for a lack of a better term there. So year over year pending transactions, though, that was month over month. The 0.8 was expected. Month over month came in at down 7.1. Year over year pending transactions are down 18.7%. So pending home sales definitely trending in the wrong direction. And it's really a matter of you have low inventory. So number one, there's not a lot of options. But number two, even if there were options, why do you want an 8% 30-year mortgage rate? So unless you have cash right now, things are not great, especially, I really feel for first-time home buyers. They've really had to readjust their plans on where they're going to go. Is it time to buy now? Do we keep renting? Do we pay? It's not like the housing prices are coming down and mortgage rates are up. That's what you see a lot of time. No, the housing prices are actually still up, although they're coming down a little bit. They're still inflated. Interest rates are very inflated. So it's just not a great mix. So new home sales. So that was pending home sales. Now we're going to go into new home sales. Those dropped in the month of August, falling 8.7% to 675,000 units. And the median price dropped to 430. So a little bit of relief there, I guess, for some home buyers. Came down from 436,700 in the most previous month there. So some relief, I should say. Inventory, though, that's been the issue. Inventory is already low. It is down 46% from a typical month in the pre-pandemic era. So not looking at, post-pandemic, in the pre-pandemic era, we are down 46% from those normal levels in terms of inventory that's out there on the market. So has anyone out there, of the folks that are tuning in right now, I'd be curious to know if you have bought or purchased a new home over the past, call it 18 months. How many of you have purchased a new home in the past 18 months? Let me know in the comments. Would really be interested to hear those stats and stuff like that. Speaking of the comments, let me head over there real fast. It looks like we got Andre's in the house. Good day from Sydney, Australia. What time is it in Sydney, Australia right now, Andre? I know you joined when we did our Saturday edition this past week. That was fun. We had a ton of international folks that were joining there. I want to say we ended up with 8 or 9 different countries that tuned in for the Saturday edition of the Dividend Power Hour. So that was really fun for all the folks that were able to join then that typically aren't able to. What do we got here? Information, the great face blue smiling. I have 1,500 shares of Realty Income at $53.34. I pick up more, but prices keep going down. Looks like I'm trying to catch a falling knife. It's really been like that since, it was at $60. I always said I liked Realty Income over a yield over 5%. It's typically been a great time to buy during normal market conditions. Now we're at a period where we're in a higher rate environment, but we're nearing the end of that. Realty Income, very high quality. This is that time where you got to focus on quality. We're going to have a slide in that here in a few minutes, but quality is important. And you take this, why the markets are down, why you're young. This is your accumulation period of your life where, hey, would you rather be able to buy 1,500 shares of O right now? It jumps up to $60. Oh, you're perfect and great. You're like, okay, I nailed that one. But then you're going to get down 5 years from now and say, man, I wish I had 15,000 shares of Realty Income. Why it was hovering at those low prices. If you do your due diligence, you're content with the management team, which they have a very good management team. The tenants they have, there have been some issues there. That's really where the concerns are. But the major concerns right now with real estate is higher interest rates. That's what's lagging. A lack of consumer confidence moving forward. But Realty Income is what I do is I'm not backing up the truck or any means. I think it's a fantastic valuation right now at 13 times AFFO looking out a year. So I just keep nibbling every week. The market gives me this opportunity, whether it's for a month, whether it's for 6 months. I know Realty Income is a high quality company. For my REIT exposure, Vici and Realty Income are my 2 largest. I'm just going to keep, hammering away at it, not backing up the truck, just nibbling and building up that position as we go. So, but there are ways when you can see a falling knife, and it's going to be on the higher risk type stuff, not as much on quality. So Jim's got a question. I'd be curious to know of the people being laid off and find work immediately are accepting positions at a lower wage, just trying to get back into work just so we don't have that gap of no income outside of, unemployment, placing limits on their disposable income. That would be a very interesting, poll. I wish I could, on StreamYard here is what I use, but I wish I could do, live polls. So instead of asking like, hey, question, answer A, B, C, or D, I could just throw a poll out there and you guys could start clicking it. But if any of you know, I'm not a tech savvy guy. If any of you know how to do that, definitely let me know or reach out via email. James, with lots of good deals in the market, is it better to put all funds into one thing like O, or dollar cost average down into several positions? Well, James, that's really going to depend on what your, I don't know what your portfolio looks like. If O was your only thing, then no, I would never want 100% exposure into that. I don't like to get single stock exposure over, maybe 7 to 10% is probably the max that I go within my portfolio. ETFs are a different story, but that single stock exposure, not looking for an individual stock to have over 7 to 10% or so in my, portfolio. So I think, dollar cost averaging is kind of a different question. It's like, do I, if I have $1,000 to invest, do you throw it in now, or 10 grand, whatever it may be? Do you throw it in all at once, or do you just start accumulating, once a week, once a month, whatever that is? Dollar cost, there's no scientific advantage to it. It helps take out the psychological or the market timing. That's a game that very few people win, is trying to time the market. So with that being said, as long as you continue to do your due diligence and you look at the valuations this week, okay, it's at 13 times, boom, I'll buy. A month from now, still at 13 times, boom, love it. If for some reason it popped up over a month or so and you're trading at 17 times, and you go, okay, maybe I wait a little bit and see if this got overdone, it'll pop back down maybe to 15, boom, I'll buy again. I like the approach of dollar cost average. I never jump in and say, hey, I want to put 10 grand into Microsoft. I'm going to start with increments of 2, and I'll just do that and build up my position, because I'm terrible at market timing. I focus on long term. I like to get in at good valuations, but rarely is it the exact bottom there. So good question there from James. John bought a condo in March for my son, but I paid cash. There you go. So cash kind of throws out that high interest rate completely out the window there. Investor's Edge. It's almost the dividend Investor's Edge there. That's our weekly newsletter. I was about to and was under contract to purchase a nice home in Laplace, but ended up backing out on the 9th day of due diligence period after paying $350 for an inspection. I think we're having a lot of those folks that, they enter into the deal, it gets a little bit closer, and then they have, second thoughts, whether it's something that may go wrong with the inspection, or just saying, it doesn't make sense at these high interest rates right now. SSH been nibbling at SCHD, PayPal, Ulta combo. I do like Ulta. That's a good one. Not a dividend paying stock. So, all of our dividend investors out there, don't scold me for that, but I do invest, believe it or not, I invest in non-dividend stocks. Secrets out. But I did buy some Ulta in my account this week. I'm glad I didn't buy it, because it would have been miserable. Sydney, it's 9 a.m. in Sydney right now. Perfect weekly morning broadcast for me. I'm good to have you tuning in from Sydney, Australia. There's the dividend investor, the CPA himself. Hello, all. I've been adding to the following. Agree Realty. Wow, we've had a lot of Agree Realty. Is that did that fall off a cliff or something lately? That's like the 7th person. I already own Agree Realty, but okay. So what do we got? Over the past 5 days, down 3%, not even 10%. So we're in a correction over the past month. Okay, so Agree Realty, Vici, Waste Management, BAM, BN, and NA. BN is Brookfield, and NA is National Bank of Canada. Never looked at that one before. I know there's a lot of folks, a lot of dividend investors that like those Canadian banks. I need to look at them more outside just the top dogs. Greg Madden. Oh, that said Greg Maddux at first. The old Atlanta Braves pitcher. Started buying some Realty Income and some SCHH 2 months ago. My intro to REITs has not been fun. Yep, it has been. If you have gotten into the REITs over the past few months for the first time, definitely not fun. But a lot of, I don't know if you guys have watched my video already today. I included one REIT in the top stock to buy for the month of October. I talked about how an analyst came out with a lot of the research that they had when we talked about the turnaround in commercial real estate. Now, not all of commercial real estate is going to turn around. Office is still a major, there's still a lot of issues going on there, and how that environment's going to look moving forward with this new work environment. But, one sector that I continue to like a lot outside of Vici and casinos, hospitality there, but is industrial warehouse. I just believe that e-commerce even if we do fall into recession, things come down a little bit, but e-commerce is going to continue to penetrate more into retail sales. Right now, it hovers right around 15% of total retail sales. That's expected to grow about 1% each year. So next year it's 16%. Then it's supposed to account for 17, 18. Each of those next 3 years, looking out in a research report that I saw there. So that's, there's a lot of companies that need somewhere to put this inventory, whether they want to have a brick and mortar, they still need a spot to put inventory, or whether you're going to be 100% online, you can't keep it in your garage. You're likely going to put it in the likes of somewhere like a Prologis, and Prologis' largest tenant is Amazon.com. So stick with the REITs, stick with high quality. I think, in the long run, if it's a short term, if your horizon's like 2 years, maybe, it's not a great spot to be there. Jeppy, buy good from Thailand. Good to another someone from Thailand there. Awesome. So we have more international exposure. I love it. Jeppy, never been a stock for me. If you're looking for some short-term yield, I think it's a solid spot to be. I do a lot of options trading myself. I have an options workshop coming up here next week. So if you guys are interested, you're brand new to options, you want to see how I do it myself, we're going to be doing a 2-day workshop, and I'll have a slide on that here in a second to kind of tell you a little bit more about that. Bought some Instacart. It's a little IPO play there. Some O and Pfizer. Sorry, a little late. No problem. There's no being on time or late here. You just come, and we're glad to have you. SCHD from the free stock promotions. The Steelers bought lots of Agree because of their low debt, little due until 2026. Andre added some Vici, some Visa, ASML. That's one I've been looking at. And Texas Roadhouse. There it is. Our third week in a row of Texas Roadhouse being mentioned, and I still haven't eaten there. Also started a position in McDonald's. So again, McDonald's is one we covered in our most recent video. So if you haven't seen that, definitely check that out. Andre also added some CP. Sean, I started investing in O again on a bi-weekly basis, bought some O last year and sold all positions at 71. Well, that was good market timing right there. Insurance is related to real estate, bought AFL, sneaky dividend play. Love it. So some good content there, guys, from you. And I appreciate all of it. So let's keep going on the slide deck here. Here's a look at the September. And if you recall, I've mentioned in my videos, I've mentioned on our Dividend Power Hour in the past that September has historically been the worst month of the year for stocks. And I think that held up pretty well. Nothing new here in the month of September, whether it's seasonality, whether it's due to the Fed keeping interest rates higher for longer, whether it's due to higher inflation, whether it's due to consumer confidence moving forward. Whatever the case may be, stocks acted as we pretty much expected, and a lot of folks were looking at. So as you can see here, the Dow Jones was down about 3%, which has been the weakest performer of the three so far, but it was actually the best in September. The S&P 500 down about 5%, and the NASDAQ was down 6%. So technology really struggled in the month of September. I think, the XLK, which is a select sector spider, covered that in my most recent video, was down about 8 or 9% or so in the month of September. And we still have, a day left of trading to go. So definitely something to keep an eye on there. So now looking forward. So we've kind of gone through, we've looked at, a lot of the data that came out from the previous month, housing, consumer confidence, where interest rates are. We know what the Fed's decision is, moving forward. Now let's take a look forward. We think that earnings are going to start to reaccelerate here in Q4, analysts or whoever it is. And then we note in 2024, they really expect earnings to ramp up in the S&P 500. My question to you guys in the comment section is, what is the catalyst for the market to move higher? Do you believe that the market's going to move higher? If so, what do you believe the catalyst is? Is it lower interest rates? Maybe the Fed's going to start cutting rates in the middle of next year. Inflation coming down? Is it technology growth reaccelerating? Maybe the earnings reaccelerate above and beyond expectations. What do you believe that the catalyst is? Because we talk a lot about a lot of the headwinds that are in the market right now and why you need to be concerned as an investor. I'm never a channel that's going to come on here and tell you, everything's Goldilocks, it's perfect, just invest, close your eyes. That's what we did in 2020. Everyone was a stock market expert in 2020. You can throw a dart at the wall and whatever stock that hit, you invest it, you likely made money. That is long gone. We now have to, it's all about fundamentals and having a game plan on why you're investing in a stock. No longer can't, we've seen it with REITs. A lot of folks have lost a lot of money in REITs. I've lost money in REITs. But it's about positioning your portfolio in the right way. So let me know, what is the catalyst for the market to move higher in Q4 and beyond into 2024? Let me know in the comments section. while you guys are going through that, I'm going to take a moment to tell you guys about my 2-day option workshop. Again, if you guys are brand new to options and you want to learn and understand how I utilize options on a weekly, monthly basis to generate $5,000 of income, obviously I don't just hit 5,000 and be done. It could be some months it's $3,000, some months it's $7,000. I really shoot for that $5,000 mark there. So we're going to go over what options are, all the different strategies, understanding how you can do them. I'll show you exactly how to trade, make sense of that. Then we'll go a little bit more deeper and look at actual strategies that I utilize. This isn't an option workshop that you're going to come in and say, hey, buy this course. We're going to turn 5,000 into 5 million overnight. I'm going to show you how to do it. No, that stuff you can go buy on TikTok. I'm not on TikTok. This is going in depth and teaching you how to do it in a responsible manner. So if that's for you, definitely check it. The link's going to be down in the description below. We only have a limited number of options or available seats for this. So definitely check that out down there. There's a link. You can fill out the information. We will get you more info and you can sign up for that. So you're going to learn how to trade different strategies. We'll go through a lot of the ones I use: selling covered calls, selling cash secured puts, utilizing option spreads, which will put a floor in the amount that you could potentially lose, and then buying and selling just regular call options or put options, buying puts or calls. And the risks around them. It's always important to understand the risks and to mitigate those risks. It's using your own cash or leveraging stocks that you already own. So it'll be a 2-day workshop. It's going to be a lot of information that first day. The second day we'll get more in depth. And we're also going to I'm going to bring on another friend of mine that does options full time with me over at Cashflow University to answer some questions. We'll both be taking some questions from the different panel or different members that show up to this. So if you're interested, check out that link down there. They're filling up quick. It'll be October 3rd and 4th, and I believe it'll be starting at 5 p.m. Pacific time, which is 8 p.m. Eastern time if you are interested. So now let's keep moving. Let me go first, and let's see go back to our question for the audience. What do we get here? What is the catalyst higher? We'll start with Steelers. The Fed to say increases are done and then the market reverses. Okay. Lower interest rates. Same thing there. Lowering of oil prices. Yeah. The price of oil. What are we still in the low to mid? Crude oil ended at, or right now is at 91.90. So it came down about 2% today, a little bit of a relief. But usually, it falls 10%. It takes, like a month for it to show up at the gas prices. And it's usually not a 10% drop in the gas prices. It's usually like 10 cents. What else we got here? Lowering of oil price. Politics, big election year, 2024 is investors' edge. Since the market is forward-looking, I think the market will start moving forward when they pivot and decide to stop raising interest rates. And we're very close to that. That's a lot of the momentum that we've seen in the past is, sure, they might increase interest rates one more time, which is what we're expecting. One more time, at least this year. I only think there's one more time period. Then we're going to go for this long pause and then eventually get to some rate cuts there. So that's kind of my take on interest rates. Jim thinks freezing of the interest rates hikes. The dividend investor CPA would say the catalyst could be lowering interest rates in the middle to back half of next year. Totally agree there. Inflation. So the Fed's seeing that they're making headway with inflation, and that's starting to come down. Inflation decreasing as a result of the base year effects, and then acceleration of earnings. So kind of a mix of all of these kind of coming together. So that is a good take, a well-rounded take there as well. I've not yet delved into options. So if you are interested, definitely check out the link down there. It's going to be for anyone that's been getting into options over the past few years or just complete beginners there. Earnings expectations is what he meant there. Lowering of interest rates for Jordan. Domestic oil opening up, perhaps. It's an election year after all. I don't think the market is going higher. Interest rates are high. Student loans are starting. That's a good point there. And the bond market is paying well at the moment. Yep, we're going to look at all of that here in a second, Fabio. Those are some great points. Lower interest rates and lower yields. And a tag on. And while the market is running, the economy will be crashing until the Fed starts cutting rates. I could be wrong. This will be my first recession, so I'm a rookie investor. We all start somewhere. And the key there, Investor's Edge, is to focus on understanding and learning. Don't just go through it and just say, oh, it happened. Understand why it's happening, and just try take in that knowledge. Be a sponge. That's kind of my advice there for you moving forward. So, all right, awesome. Let's keep rolling here with the slides. So one of the catalysts that I've kind of noticed is a lot of this uninvested cash that's on the sidelines. So we have, these millionaires and billionaires that have, calling these wealthy, ultra wealthy. These are folks with at least $1 million in the invested. And right now, a lot of it's on the sideline, dating back a few months ago. So this isn't like updated as of right now. High net worth individuals were holding roughly 35 of their money that's invested, whether it's bonds or stocks. 35% roughly 35% is held in cash. So that's a lot of uninvested money that if it pulls out of cash and goes into the stock market could feel it higher there. This 35% is the highest level dating back to 2002. And then the prior year, looking back in 2022, that number was closer to 25%. So that was a big key last year, was saying, okay, there's 25%. Maybe we got a surge in early part of 2023, and now folks have kind of delved back in and dove back into higher interest rates, high yield savings accounts, short-term bonds, and stuff like that. So there's just better alternatives for investors right now. It's like if you can get 5 to 7% of pretty much risk-free right now, what's the why would you go out and buy this is what folks are saying. Why would you go out and buy something like Realty Income? Sure, you're going to get 5.8% yield, but you're also going to see the stock price dive down 10%. So really, it's a negative total return. Why would you go out and buy something like WP Carey, and then all of a sudden, boom, you have that risk of, you never know, the options sell or the office segment was going to be sold during this time. The dividend was going to be cut. Now you're down 20% or something overnight. There's zero risk pretty much. I'm not going to say zero because nothing's ever zero. So there's very little risk with these U.S. treasuries, these short-term U.S. treasuries. Again, like I said, I'm getting 5.4% right now at a high yield savings account. So definitely, I have a good chunk of cash in there right now. So definitely something considered to when that starts moving back into the stock market, we could see a swift move higher there for the stocks. So what else do we have? I'm a beginner investor myself, and that's perfect. We're always looking for new investors to learn. We also have the 6-week program. If you want to work with me one-on-one, we start from a very low level or a very slow level and work our way up into how we value stocks and how I do it exactly. So if you're interested in that, there's a link down there as well. What do you suggest for new investors who have recently invested in REITs? Keep buying aggressively or slow down a bit until the market stabilizes? Good question there. So if you're young, you have a long-term horizon, I don't think aggressively is an area right now. I think you want to set up your portfolio for success. So you don't want to have too much exposure to REITs. I usually keep around 15% or so exposure to REITs. I've kind of been dwindling down the number. So if you subscribe to my premium newsletter, you can see my monthly dividend portfolio. Actually, it's my entire portfolio now moving forward, because I put out a poll. I said, do you guys want to see my entire portfolio, or do you just want to see my dividend portfolio? I've always done just the dividend. So this next one, more folks said they want to see the entire thing. So you'll be seeing my Googles of the world, my Ultas of the world, so on and so forth. But I only want to keep about 15% to REITs. I never want to be overexposed like that. And right now we're in this period. Yes, the interest rate hikes are coming to an end. It seems like we may only have one, maybe two max. I think it's only one. But given that standpoint, REITs are expected to turn around in 2024. So, I'm taking this opportunity I'm not doing aggressive buying. I'm nibbling, because as we've seen, O went from 60 to 58 to 55, and everyone on social media saying, oh, wow, O at 55, O at 52, O below 50. I did that tweet this week, O below 50. So I think it's really just being cognizant and having that diversification, looking for areas. Again, high quality is what we want to focus on right now. Realty Income is high quality. You're not asking about that one specifically, but not taking high risk there, just not knowing, because if we do in fact fall into a recession, it's not going to bode well for a lot of these companies either. So something to kind of keep in mind. But good question. What other questions? Technically, it's my second year investing, but it's been a wild ride, I must say. I was up 7,500 last month. Nice, just to see it wiped out in the month of September, as is the market and the month of September. So there you go. So now moving into your third year, you're going to know that historically, September is a month that it can be difficult for the stock market. There's a lot of, it's the end of a quarter, so there can be some tax loss harvesting that go on. There's hedge funds that really start to reposition for the fourth quarter, because again, they have to print out, they have to show what they were buying and selling as of the end of the quarter. They don't have to do it for about a month and a half, but there's a lot of, positioning and stuff that goes on during the end of the end of a month, at the end of a quarter, a specific quarter. So at the end of March, at the end of June, at the end of September. But historically, September is the worst month for stocks there. So just continue to learn. Better late than never. That's exactly right, Kevin. Best info I have heard in a while. Good. Awesome. O was 49.90 at closing today. There you go. O below 50. So that kind of leads perfectly into this quality is a factor. That's kind of my whole emphasis right now on my entire portfolio, is not focusing as much on the higher risk stuff. Still continue to do my options, but focusing more on quality. Quality is a key factor right here, because Q4 is historically the best quarter. So we just went from September being the worst month, now moving into seasonality being the best quarter for the entire stock market. So there's some upside there. Rates are expected to be higher for longer. So understanding that, and whatever company you invest in, understand how are higher interest rates going to impact this particular company. Going back to Realty Income, they have a great credit rating. This is one of the things that gives them an advantage against other REITs out there. So if they need to go out and get debt, they're going to get debt at a much lower rate than the likes of NetStreet or Agree Realty or something like that. Even though I like those two, that's the advantage, a much lower debt rate there. So their cost of debt is going to be much lower, a big advantage for them. The other thing to think about is it takes months, sometimes years, for these interest rate hikes to play out through the market, because we went through this period during the pandemic where companies, it wasn't just companies, it was companies and consumers saved up so much money that their savings just ballooned. We've seen that, be wiped away per se, but we're pretty much back to neutral now. And but what I'm trying to say there is these companies haven't needed to go out and get debt. A lot of them haven't needed to go out and get new debt. Well, now we're coming up to a point where we have debt that's starting to expire, or it's time to, hey, we need to refinance debt. We need to go out and get new debt. We have some growth initiatives here. Well, debt that you got 5 years ago, 10 years ago is much more expensive today. And that's where things are going to go play out. So with housing, I don't think it's going to be, it's already starting to slow down. It's going to impact new buyers, but a lot of folks right now are just going to stay put with their 4, 3, 2%, sub 2.5 or whatever mortgage rates. It's not going to impact their day-to-day, their financials right now. But auto loans, autos don't last 30 years, 50 years like homes do. Homes last much longer than that. But cars only last, 5 to 10 years, where that is going to start playing when folks say, oh man, my car just went out. I need to go buy a new car. Holy smokes, look at these auto loans. So that can impact the consumer there as well. Earnings are going to be key during this period. There's very high expectations. Even though they've come down a little bit, it's still high expectations. We've seen these muted or these negative for the past few quarters. Now we're going back to 9+% earnings growth moving into 2024 as well. Those expectations are high. Can that come to fruition there? And then again, the Fed is nearing the end of this cycle, but past hikes, like I mentioned, are still starting to play out through the system there. So something to definitely keep an eye on. So here's our normal ending slides here. So, year-to-date performance, we're still led by communication services. That's Meta and Google. And then you have information technology up 32%. So both of those are up over 30% on the year. You got consumer discretionary up 23%. The S&P 500 is up 11 right now. Energy has been a big mover of late, up 5.3. They went from negative to positive over the past month. For the year, I should say. Industrials and materials squeaking out a green year so far. Financials, healthcare, consumer staples, real estate, and utilities are all in the red for the year. Moving over to the past month, should be no surprise that energy is the leading sector there, up 6.3%. Communication services barely at 0.2%. And the rest is red. Look at these numbers. Real estate, as we talk about, they just got hammered. WPC lost a ton. All of them were getting hammered. And I've again taking this opportunity to buy quality. Again, I don't invest in REIT ETFs. I invest in high quality. I just want about 5 to 10 names, high quality there. So healthcare's down. Materials has been a section I've been looking at with ALB. That's an interesting, not a REIT, but materials company there. So if you're interested, you're a new investor or an intermediate, you've been investing for 0 to 5 years, anywhere around there, and you're looking for more help in the market. You're like, hey, I'm really interested in investing, but I don't even have a game plan. I don't have a strategy and action plan. I don't know how to value stocks. Definitely check out my 6-week investing course. So right now we're on a waiting list. We just sold out for our October one, but in a few weeks, we're going to open it back up. Because I have some folks that get through it in a matter of 2 weeks. So if you're looking for this course to take in the middle of October, then definitely there's a link down below. If you can sign up for it now, save your spot for when we open back up. But you'll be working with me one-on-one. It's 60-minute sessions, and we're going to put together a customized strategy for you and an action plan that's not just available for you to use today. It's something that you can use for decades. And we're going to get into breaking down the financial statements the same way I look at companies to determine, is this dividend safe? Is this company have enough liquidity on it? Is it safe based on the debt levels? All of that stuff. We're breaking down the financial statements and then moving even further to determine, is now the right time to buy a stock? We look at charts. We look at all of these different metrics that I look at: price to earnings, price to EBITDA, price to free cash flow, the importance of free cash flow. All of that stuff is covered in this 6-week course. So if you're looking for a detailed course to work with me one-on-one, definitely check that out. And then if you just want some more weekly information just sent straight to your inbox, then definitely sign up for the premium Dividend Investors Edge newsletter. My 2 stock deep dives will be coming in the next 2 days. I just wrapped up the last one, and the one that'll come over the weekend will be a good one as well. So excited to send those out. So what questions do you have? That wraps up our Dividend Power Hour slide deck now, but let me know if you have questions. And if you guys are still interested in that workshop, make sure, those ones are limited. Ask away and sign up for that if you don't have any questions there. So what else do you guys have out there? I'll stay for a few more minutes, answer any questions that you guys might have for me. What do we got? MPW, not a stock I want to own, a stock I got rid of long ago in the 30s. I've mentioned that a bunch on this Dividend Power Hour. So, a lot of people can vouch for me there, but, just never been impressed with a management team. And that's one of the quality factors I look for when investing in any company, whether it's a REIT or a non-REIT. It has to be a quality management team that has shown its ability to lead the company, make strategic acquisitions, be forthright with questions that analysts ask. And that management team has not been able to do that. Don't like the overexposure to a single tenant. I usually like to see that spread out a little bit more. So, for those reasons, and I think it's been right, I'm just going to, stick with not owning MPW, I should say. Investor's Edge, that's 1,500 of my recent losses came from MPW. I think and hope they found their resistance point. So Investor's Edge, what the thing you want to learn, and one of the things I tell folks all the time that I work with, is the fact that you never want to chase yield. The yield looks great. If you look at, some of these high yield dividends or ETFs, whatever it may be, and you see 15%, there's red flags. And you want to understand, you can see a 10% yield on a stock and know, if just knowing a few things by looking at the cash flow statement and understand, I could tell you within probably 5 minutes or less whether that dividend is safe or if that dividend is going to be cut. And there's certain factors that we look at, and that's exactly what we do in our 6-week course, because you never want to invest based on yield alone. That's when you're catching these falling knives, but that one's not stopped falling really when it comes to MPW. Oh, lower loss aristocrat. So, Realty Income, we've talked already a lot about it, so I'm not going to kind of regurgitate a lot of that, but high quality company, not backing up the truck, but just nibbling at it while we have the chance. Because I think if you go 5 years out from now, you're going to look back and say, man, I wish I bought more Realty Income. First SPDN, then VU, then triple Qs, then T triple Qs, SCHD. What else would be good? So you got a lot of crossover between those three, especially with those top holdings. So definitely something to consider there. SCHD kind of broadens things out a little bit. SCHD has lagged the greater market just due to the fact that it doesn't have the technology exposure that the S&P 500 has, that a lot of these other growth ETFs have, and stuff like that. I want to say it's the 5th largest exposure, maybe around 12%. So when we get a broad stock market move, all sectors are working, or not just 2 or 3 like we've seen in 2023. That's when SCHD is at its best. So right now, just knowing that, it's still a high quality and a favorite dividend ETF of mine. Let's bring up this real quick and let's look at Let's look at something real quick. The one thing I like to look at a lot of the time is I like to compare the S&P 500, and we used to do it a lot on the Dividend Power Hour here, is look at the difference between the S&P 500 and the equal weight S&P 500 to kind of see the difference between the two on the gap. And the gap has been at a 14-year high. You know, it's usually, if you date back, look, if we go out over past 10 years, you can see how closely the equal weighted S&P 500 and the market cap weighted S&P 500 tend to trade. But right now, it's like one of the largest gaps you've seen. So you have an equal weighted S&P 500 that's pretty much even on the year, and you have a market cap weighted that's up 12%. That tells you that those large cap stocks that's what's been working. The other 400 plus stocks, it's not a great economy right now, and that's showing right there. So definitely something to kind of keep an eye on there with that equal weighted difference between the two. All right, what other questions we got? Any suggestions what to do with WPC? It's been a recommendation, but I have a lot of my principal now. So WPC, you know, I think if we're thinking long term, 5-10 years out there, I think, you know, getting rid of office is a good, because I don't have any, you know, real office exposure. I don't invest in office REITs. The only one I do have, or I don't know if I remember if I sold it or not, was Alexandria Real Estate. They get mixed up with office REITs, but they're not a true office REIT. So they're more biotech type of stuff. So I don't really have office exposure. I had WPC. I sold it after one of the first drawdowns. So, you know, I still got hit on the pullback, but it's just my standpoint I took. It was the fact that there's a lot of great opportunities out there. Like I'm looking at at a below 13 times FFO or 8 FFO multiple right now. Why would I mess around with WPC that clearly has other issues going on? They have to cut the dividend. The timing of this was just terrible. So at that fact, I lost a little bit of confidence in the management team. When I invest, I want to be able to sleep well at night. So with what's going on there, that's when I just cut my losses, but move that capital to something rather than saying, you know, you could be waiting years like, oh, it's going to turn around. It's going to turn around. It's going to turn around. Or you can just say, let me just cut my losses, especially, you know, look into your tax loss harvesting. Do you have gains that maybe you sold off? You could put those against each other so there'll be no tax effect on any of your gains, something to consider depending on what type of account you're holding this in. So for me, I got rid of WPC. MPW, nothing to write home about. There is absolutely nothing to write home about them. Gretch, there you are. You made it. Awesome. Jim, I'd go to Vegas and put it all on black instead of buying MPW. There you go. It'd probably come out with a better result too. What do you think of Costco? I want to buy, but very pricey. I get lost in a Costco. You know, there's two stores that I love going to, Costco and Home Depot. You know, I don't know. I just love going to Costco. It's one of those companies, and it's interesting the fact that, you know, they had solid earnings. I just covered it. You know, we do earnings recaps for premium subscribers. So I just covered Costco and their earnings that came out. I give you an infograph and everything. They had solid earnings. Their traffic is up. You know, there's a lot of concern about the consumer, not Costco. Their traffic was still up 5%. Their earnings are well. And a lot of the issues around retail lately has been the fact, you know, Targets, Walmarts, even Home Depot have been dealing with theft. Costco hasn't had as much of an issue as those other ones. You know, Target is closing stores in Seattle, New York, up in Oregon, and all these areas that have had, you know, high amounts of crime. And the fact is that there's a Costco, you know, the downtown New York City one. There's a Costco that's, you know, 1 or 2 blocks away from that. They haven't had the issues that Target is. And Target's saying, hey, we got to close 10 or so stores. It'll be cheaper for us to close the stores than to have them open and deal with the theft. So I think, you know, Costco has a lot that they've found out. People go there, you know, especially if they're trading down in value. The Kirkland brand is sometimes higher than the high value brand. So I love Costco. I love their products. I don't own the stock. I'm always waiting for it to get cheaper, and it just never seems to get cheaper. So it might just be one I have to kind of just jump into or sell some cash secured puts around. All right, Sean, what do you got? What will happen to the stock market if there's a possible government shutdown? I heard that the unemployment rate numbers will not be released next week if that happens. So that's you know, it doesn't have a true impact. You know, if you look back over all of the government shutdowns, which it seems like it's almost a quarterly basis now that we have these, but the fact is that it shouldn't have a direct impact on the stock market as a whole. Where it will have an impact, as you're alluding to, is the fact that a lot of these government agencies have to shut down. So if it's a prolonged shutdown, the Fed will be going into their next meetings blind. They won't know what CPI is. They won't know what unemployment is. And all of these numbers that are usually published to them that help them make more thought out decisions on whether to hike rates or not, especially, they want one more rate hike to end 2023 and there's only 2 meetings left. That tells you that they're going to go into this blind. So that's where things happen, is you don't get a lot of these government, the housing data or whatever it comes from the government won't be published on time there. So they'll catch up once it reopens, but that's some of the concerns there. But in terms of, the stock market falling or popping, you've seen it go kind of both ways. Actually, the most recent one that happened was probably one of the largest moves the stock market has seen during a government shutdown. All right, a few more minutes for me. What do you think about Cornerstone? Not as familiar with it. Stop putting funds MPW. What should be the focus for new long-term investors in this market? Building out safety, building out a solid foundation. I teach this in the 6-week course, talking about, whether it's relationships, whether it's investing, whether it's a job, it all starts with having a solid foundation, something to fall back on when times get tough. You don't want to have your entire portfolio built around maybe a high growth, high beta, very volatile type of position or 2 positions or something like that. I like to see mine built on an S&P 500. 500 of the top companies in the US is always going to be the top position within my portfolio. And then I start sprinkling around if I want individual stock risk, higher risk, higher reward type of stuff. That's what individual stocks will give you. But I want to build that strong foundation. So for me, if I was just starting out right now, maybe that's a video I do. If I were a new investor, here's how I build out my portfolio with my first 100,000 or something like that. And I could show that. But, I would start always with an S&P 500 ETF and build that up first before jumping into anything else. I wouldn't drop O just because they're having a setback. They've been around for years and they've grown their dividend. They do grow their dividend. They actually grow their dividend on a quarterly basis. They pay a monthly dividend. They grow it on a quarterly basis. The growth is quite little, though, 1% or something like that, a couple percentage points. But they are a dividend aristocrat for having increased their dividend for 25 consecutive years and counting. Gretsch, I did a project for HD Distribution Center, and it was fantastic. Great staff and the cleanest warehouse. It's always interesting. You get different. I always do. I'll write articles on Home Depot versus Lowe's, and people bag on Home Depot for being dirty or bag on Lowe's for being dirty, and or good customer service here, bad customer service there. And it's always like 50-50. It's really just dependent on where you're at. But I love Home Depot. Are REITs like a total return investment? I look at every single stock that I invest in, every single ETF that I invest in as a total return investment. If I'm going to get 10% return from Realty Income and I get a 5.5, that's 15. That's my total return. That's what I'm banking on. I'm not expecting Realty Income to outpace the stock price of Apple, but there's goals I want. I'm not looking for 1% to 2% returns. I take in the entire picture. You have to take in when it comes to, especially with dividend investing. A lot of folks say, well, you're a dividend investor. Why would you want to invest that much money for $200? Why would you want to invest for just 3%? Well, buddy, it's not just 3%. Broadcom pays a 3% dividend yield. Do you think I've only got a 3% return from Broadcom? No, I'm actually up 60% in the share price, and then I get a 3% as well. Oh, and by the way, they increased their dividend 25% for the past 5 years on average. So there's a lot more to look into it than just the yield, and that's kind of the clowns on social media that'll attack dividend investing. Dividend investing is a total return investment. Investor's Edge, I think VU is my favorite out of those 3 choices. And then Peter, DCA into HD this week. Dollar cost average into awesome. So that pretty much puts us right at 5 o'clock, folks. So it has been a joy to be with you guys. You guys had some great questions. Thanks for being here live. It's always fun to kind of get different takes and answer your guys' questions. But, hopefully I won't see you again until between now and my 2-day options workshop. So if you're interested in learning workshops or learning options, you're brand new to options or you've only been doing it for a few years, definitely sign up for our 2-day option workshop that we have October 3rd and October 4th. It'll be online. We're going to be taking questions live, go through a slide deck and all that. So the link will be down in the description below. I hope to see you guys there. Hope to see some familiar faces. It is a limited number of seats that we do have open right now. So the sooner you know, the better. And if you do want to work with me one-on-one, definitely check out that link down there as well. So thanks again for all the support you guys give, for a lot of the familiar faces, a lot of the new faces. It's always a joy to be here. And you guys have a great evening and a great morning for those of you over in Australia and international. So we'll see you next week, though. Take care, guys. Bye-bye.